Welcome to the deep dive. Today, we're looking at a company we're calling Strategy. They're doing something pretty interesting at the intersection of corporate finance and digital assets.
Right. It's not just about holding Bitcoin. They're really treating it as a new kind of capital, what they call digital capital.
And using that to build, well, a whole new type of credit market.
Yeah.
So we're going to break down their Q3 2025 results based on the materials you shared.
Exactly. And this isn't your typical earnings call review. We're looking at some serious financial engineering here, all built on Bitcoin. The goal seems to be creating these novel assets, digital credit.
Okay, so our mission today, unpack those key financials, really get our heads around this digital capital idea, and maybe most importantly, analyze these new credit tools they're using to fuel some really massive growth.
Sounds good.
Right, let's jump in. Section 1, financial transformation and scale. Where do we start? The big numbers.
Yeah, let's start there. The surface level JAP results for Q3 2025 look phenomenal. We're talking $3.9 billion in operating income, $2.8 billion in net income, and 8.42 earnings per share. That's their second consecutive quarter of positive GAAP earnings.
And a big part of that clarity comes from the accounting change they made back in January, right?
Yeah.
The FASB fair value rule.
Absolutely. Adopting fair value accounting. Well, it basically meant they could mark their Bitcoin holdings to market value. That added something like $18 billion to their digital assets figure. It makes the balance sheet much easier to read.
Okay, so the GAAP numbers are strong, partly thanks to accounting changes.
Yeah.
But you mentioned that's just the surface.
Exactly, because those dollar figures, they bounce around with the Bitcoin price. The real strategic measure, the core asset, is the Bitcoin itself.
And how much are we talking?
Strategy holds 640,808 Bitcoin.
Wow.
Yeah. Put that in perspective, that's over 3.1% of all the Bitcoin that will ever exist.
3% of the total potential supply.
Yeah.
That's significant.
It is. And right now, that treasury is valued at about $71 billion net asset value. They bought it at an average cost of around $74,000 per Bitcoin.
It's incredible scale. But you mentioned the dollar value isn't their main focus. They have a specific KPI, right?
Dude, forget cap EPS for a second.
Yeah.
Their internal measure, the one that really tracks their core strategy, is Bitcoin per share. BPS.
BPS. Okay, explain that.
It's pretty straightforward, actually. It measures how much Bitcoin, measured in Satoshis, the smallest unit of Bitcoin, is held per share of their stock.
So it directly tracks the accumulation of the underlying asset per share, regardless of the dollar price swings.
Precisely. It shows how effectively they're converting the capital they raise into more Bitcoin for their shareholders. It isolates their operational success,
And how's that BPS metric been doing?
The growth is pretty undeniable. It's up 3.5 times since they began this whole strategy back in 2020.
3.5 times.
Yeah, from about 56,000 sats per share in 2020 for just over 200,000 sats per share as of October 2025.
So that shows the capital raising and acquisition engine is working very efficiently.
It really does. And they're not slowing down. For 2025, they're aiming for a 30% year-to-date Bitcoin yield.
30% yield.
That's the goal. And they're targeting about $20 billion in Bitcoin dollar gain by the end of the year, though that assumes a fairly optimistic $150,000 Bitcoin price.
Okay, so high confidence in both their ability to raise capital and the future price of Bitcoin.
Seems so. That BPS growth really sets the stage for everything else they're doing.
Right. So we see the scale, the efficiency metric. But all this financial engineering relies on a big idea, which you mentioned. Bitcoin as digital capital. Let's get into that in section 2.
Yeah, this is the core philosophy.
Yeah.
Strategy is basically saying, look, Bitcoin isn't just some speculative asset anymore. It's matured. It's become digital capital.
Like a digital version of gold, a long-term store of value.
That's the idea, a non-sovereign store of value. And, the market seems to be agreeing increasingly.
What does that look like in practice? How is the market validating this?
Well, look at the sheer size. The whole crypto market cap is around $3.9 trillion now. Bitcoin itself makes up about $2.3 trillion of that.
So it's definitely not a niche thing anymore.
Not at all. And you've got over 200 publicly traded companies holding Bitcoin on their balance sheets now. That's about $116 billion worth.
And Wall Street's role in this?
Oh, Wall Street is fully involved. The spot Bitcoin ETFs, for example, they hold around 1.5 million BTC collectively. That's huge, maybe $170 billion in value.
Wow.
And it's not just ETFs. You see the big banks, Citi, JP Morgan, Morgan Stanley, they're all getting comfortable. They're allowing Bitcoin and Ether as collateral. They're helping underwrite offerings linked to crypto, launching custody services.
So the traditional financial system is integrating Bitcoin as a legitimate asset.
It really is. They're building the plumbing to treat it like other forms of capital.
And wasn't there a recent regulatory development that helped solidify this? Something about taxes.
Yes, absolutely critical. That IRS interim guidance that came out September 30th.
How did that do?
It basically gave corporations clarity on the corporate alternative minimum tax, the CAMT. It said they could exclude unrealized gains on their digital asset holdings when calculating that tax.
Okay, so if your strategy holding billions in Bitcoin that has appreciated massively.
Exactly. Before this guidance, there was a real fear they might face a huge tax bill on gains they hadn't even realized by selling, just for holding it.
A kind of phantom tax.
Right. Removing that threat was a huge green light. It makes the whole buy and hold strategy, which is central to Strategy's model, much more viable from a tax perspective. Not just for them, but for any company thinking about doing something similar.
Okay, so the regulatory path is clearer, the market is adopting it.
Yeah.
The foundation of digital capital seems pretty solid.
Which brings us to the next step. If Bitcoin is digital gold, what do you build on top of it? What's the killer app?
And Strategy's answer is digital credit. Section 3, the digital credit factory.
Exactly. They've done some pretty clever financial engineering. They created 4 listed preferred securities, STRF, STRK, STRD, and the big one, STRC, which they call Stretch.
Stretch?
Yeah.
That was the largest U.S. IPO so far in 2025, wasn't it?
That's the one. And the core idea behind these securities is taking Bitcoin, which we know is volatile,
Very volatile.
and stripping out a lot of that volatility to create stable, high-yield instruments.
How stable are we talking?
Well, compare Bitcoin's historical volatility, maybe around 38%, to something like STRC. They've engineered STRC down to just 8% historical volatility.
8%. That's much closer to traditional fixed income.
Right. But here's the kicker. It still delivers a 10% effective yield.
10% yield with only 8% volatility.
That's the engineering part. They're basically slicing up the risk profile of their Bitcoin holdings and offering different pieces to different investors. STRC is designed for those who want yield but can't stomach Bitcoin's wild swings. Think corporate treasurers, retirees, mainstream folks.
Okay, that's clever. But you hinted there's something even more unique here, the tax treatment.
This is where it gets really interesting. The dividends paid on these preferreds STRC, STRF, STRD, STRK, they are expected to be treated as return of capital, ROC.
Return to capital. Okay, for listeners maybe not deep in tax code, what does that mean practically?
It's a huge advantage. ROC dividends aren't treated as immediate taxable income. Instead, they're considered a return of your original investment.
So you don't pay tax on them right away.
Exactly. You defer the tax. The income tax is pushed potentially 10 years or more down the line. You effectively get a 0% tax rate up front on that income stream.
0% tax up front for potentially a decade.
Correct. And this comes from Strategy-specific corporate structure. Because they follow a strict buy and hold approach with their Bitcoin and don't intend to sell it, they generate negative tax earnings and profits, or ENP. That negative ENP is what allows the dividends to qualify as ROC.
Okay, let's put numbers on that. You said STRC has a 10% effective yield. What does that become after considering the ROC tax benefit?
If you're in, say, a high tax bracket, like 37%, that 10% yield suddenly looks like a 16.5% tax equivalent yield.
16.5%.
Yep. Compare that to other low volatility options today. Money markets might give you, 4% if you're lucky. Taxable bonds maybe a bit more.
The difference is massive.
It's huge. The source material calculates that just by reinvesting those tax-deferred ROC dividends over 10 years, you end up with 44% more value than if you'd received the same yield as ordinary taxable interest.
Because you're compounding the full amount without the tax drag each year.
Exactly. It's a powerful mechanism for maximizing long-term returns.
But it all hinges on them sticking to that never sell Bitcoin strategy, right?
Yeah.
To maintain the negative EMP for the ROC treatment.
That's the critical constraint. It's the tightrope they walk.
Does that create risk? What if market conditions change drastically? Can they really lock themselves into never selling for potentially decades.
It's a core part of their value proposition. That ROC treatment drives investor demand. If they deviated, if they started selling Bitcoin and generating positive EMP, the tax benefit would disappear and the appeal of these securities would likely plummet.
So they need extreme discipline.
Yes, which is why they're focused on raising permanent equity capital through these preferreds, not debt. Their whole model is built around this permanent holding strategy and leveraging the tax code benefits that come with it.
Makes sense. Okay, so they've built this innovative structure. Now let's talk about how the traditional financial world is reacting. Section 4, access, validation, and future ambition. The S&P rating seems like a big milestone here.
A huge one. Getting that B issuer credit rating from S&P, well, it's the first time a dedicated Bitcoin Treasury Company has received a rating like this, and it came with a stable outlook.
So traditional credit markets are formally acknowledging this model is viable.
Pretty much. Now, a B rating might not sound amazing, but the key is market access.
Right. What doors do that open?
It gives them access to the global high-yield credit market. That's estimated to be around $4.9 trillion. Before the rating, their accessible market was maybe a third of that size.
So a threefold increase in potential capital pools just from that rating.
Correct. And the rating report itself is interesting because it shows the remaining hurdles.
How so?
S&P rated them under the framework for non-bank financial institutions. But, and this is crucial, they penalized strategy heavily in the calculation.
Penalized them? Why?
They deducted the entire value of the Bitcoin Treasury from strategy's equity when calculating risk-adjusted capital, or RAC.
The whole $71 billion. Why would they do that?
Because from S&P's perspective, and reflecting broader regulatory views under frameworks like Basel, Bitcoin is still seen as too volatile, too non-traditional. They don't yet recognize it as reliable capital for cushioning against losses in the same way they view traditional assets. There's a significant perceived market risk charge.
So for strategy to improve that rating, maybe get to investment grade.
Which would unlock a much, much bigger market, the $23.6 trillion investment grade space.
They need regulators globally to fundamentally change how they view Bitcoin, to accept it as a legitimate capital asset in these risk frameworks.
That's the bottleneck. Regulatory evolution is key to unlocking the next level of market access and lower cost of capital.
Okay. Despite that external challenge, internally, their capital strategy is quite specific, isn't it? Something about leverage versus amplification.
Yeah, they have a clear goal. Drive financial leverage, meaning debt, down towards zero. They plan to equitize their convertible debt over time.
Okay, less debt. But at the same time,
they want to drive up what they call amplification. Their target is 30% amplification.
Amplification. We need to unpack that term. How is that different from leverage, and how does it relate back to that BPS metric we discussed?
Right. Amplification is sort of the secret sauce of the digital credit factory. It's how they use the permanent equity capital they raise from those preferred securities.
Like STRC.
To acquire more Bitcoin exposure than the dollar amount of capital raised. Think of it as structural leverage achieved through equity, not debt.
Okay, so they raise $1 billion in preferred equity. And through amplification, that might translate into, say, $1.3 billion worth of Bitcoin added to the treasury.
That's the basic idea. It's about maximizing the Bitcoin purchased per dollar of equity raised. And that mechanism is what directly drives the Bitcoin per share, the BPS, higher over time. It's how they engineer increased exposure for their shareholders.
Got it. So less traditional debt leverage, more structural amplification through equity.
Exactly. And they believe this structural advantage is key to their long-term performance.
How much better do they think it can be?
Their projection, based on the source material, is that this model, the amplification plus their capital raising strategy, could lead to a 2.8 times better outcome for shareholders over 10 years compared to just passively holding a spot Bitcoin ETF.
2.8 times the return of an ETF. That's a bold claim.
It is. It relies on continued execution and, of course, Bitcoin appreciating.
And finally, how are they pitching this to the world? Is the marketing changing?
It seems to be simplifying, moving away from the complexities of Bitcoin itself. Towards the yield and stability offered by the digital credit products, they're also planning global expansion, designing new products denominated in local currencies like euros or Canadian dollars, trying to tap into those huge international capital pools.
And the pitch itself?
It's become very direct, aimed right at mainstream investors, corporate treasurers, retirees. The example given was basically 10.5% dividends paid monthly for those who like money.
Simple, direct, focused on the benefit.
Removes the Bitcoin complexity and just highlights the yield.
Okay, let's try to wrap this up. The core takeaway seems to be that strategy has built this repeatable model, this digital credit factory.
Yeah, they're using permanent equity capital, the preferred shares, which doesn't need to be repaid like debt,
Right.
and they're using it to systematically acquire Bitcoin.
An appreciating, though volatile asset.
And then engineering ways to extract a high, stable, and importantly, tax-deferred yield from it for investors.
It really does flip the traditional finance script, doesn't it?
It absolutely does. Traditional finance often uses temporary debt based on assets that might depreciate, which can amplify risk in downturns. This model uses permanent equity based on a potentially appreciating asset. It aims to replace those opaque, very traditional risks with a more transparent, continuous digital risk profile managed through equity structure.
A paradigm shift built on tax efficiency and relentless acquisition.
Precisely. And that leads to the final thought for you, the listener, to consider.
Go ahead.
Strategy projects this model could deliver 2.8x the return of a simple Bitcoin ETF over a decade. Now, if they're right about digital capital and digital credit, if this model works and becomes widely available, what happens when a 16.5% tax equivalent yield on a relatively low volatility instrument becomes a global benchmark?
Hmm.
How long until that kind of yield resets expectations for what's possible in conservative treasury management or even for your own savings? Think about how that compares to the yields you see today on low-risk investments. What does that disruption look like?